Hello, everyone, and welcome to this week's episode. There is a lot that has happened in this last week, and we're going to dive into all of it and break it down and talk about how it's going to be affecting housing here in Greater Vancouver. We had the inflation print come in last week, as well as the Fed down south announce their interest rate hike. We saw just an absolutely phenomenal number when it came to population growth here in Canada for 2022. And then, of course, we're going to discuss how that specifically is going to affect real estate here, along with the staggering amount of homes that are required today just to make homes affordable again. All that is coming to you. We're going to deep dive this for you. And right off the top, if it all makes sense or if none of it makes sense, we're here to help it make sense for you. So if you have any questions or want to talk about how this ever-changing landscape can affect you and your housing situation, just feel free to reach out to any of the contact information below. Okay, let's dive right into it. Hot topic number one today is the Canadian inflation print. So it did drop, and it actually dropped more than expected. It was expected to settle in at about 5.4%. Ultimately, inflation as of February sat at 5.2%. This is actually the first year-over-year drop we have seen, as it was 5.7%, and year-over-year since it started climbing back in 2020. The 0.7% drop that we just saw last month was actually the largest that we've seen since April of 2020. When inflation was dropping very rapidly due to the pandemic shutdown and the fact that nobody was buying or spending any money. Of course, if you think about this and you pull back a little bit further, the year-over-year base effects are pretty substantial, because we are, compared to 1 year ago, if you combine where we are today compared to last February's print, at about 11% inflation in 1 year. This is why things are feeling so expensive out there, because 5.2 might start to sound a little bit more manageable, but let's not forget that's coming off of, 5.7 from the previous year. So quite a large number for people to be dealing with. Groceries are leading this inflation number. They're up still about 10.5% year over year. So that sticker shock that you're getting at your local grocery store is persisting and will continue to persist for the foreseeable future right now. It's largely being blamed on, of course, supply chains still, but also there's been a lot of weather events that are hampering the growth of fruits and vegetables, especially things like oranges in Florida, for example. Energy sector was apparently one of the biggest areas that dropped the most. That's helping bring inflation back down. As a quick note here, what's kind of interesting or even funny, if you will, mortgage interest costs, understandably, are a lot higher for people, and they're a component of that CPI basket. So that metric is surging up something like 25% year over year, and it now makes up 0.7% of that 5.2 total inflation print, meaning that by raising rates to fight inflation is also helping cause inflation by our lovely Fed here. So kind of funny. Obviously, it's bringing down other sectors of that basket, but they're also creating some of the inflation that they're trying to fight at the same time with these increased rates. So March of 2022, it was 6.7%. So when we look forward as to where it's going to go next, base effects, I think we're going to see a pretty similar drop for when we hear what the March inflation numbers are. And that'll place us somewhere around the mid to upper fours, which we obviously have not heard of in a while. But again, it's trending the right way. And as of their last statement, BOC still thinks we're going to be sub 3% by June. Here's hoping.
That would be very interesting if we hit, sub fours by June, if we're in the threes, because that will directly affect the 5-year Canadian bonds, as we're already seeing. So to give you guys some perspective here, about Dan, 2.5 weeks ago, 5-year Canadian government bonds, before the failure of Silicon Valley Bank, before the failure of, I think it's Silvergate. Anyways, before the bank failures in the States took place, the 5-year Canadian government bonds are sitting around 3.6%. And now they are currently trending downwards and have been since, down to 2.793%. Now, I know a lot of people don't know really what that means, because who the hell follows Canadian 5-year government bonds? But if you're thinking of buying a home here and you're looking at mortgage interest rates, this is something you're going to want to pay particular attention to, Because if the 5-year Canadian government bonds actually stay low, then mortgage rates in Canada are likely to go down as well. This is because mortgage rates are largely influenced by long-term interest rates. We know that. The 5-year bonds are a great benchmark for long-term rates in Canada. So to give you guys some perspective, the last time we saw bond rates at 2.8% was back in 2010. Now, we weren't dealing with inflation the way we were or the way we are today. And to give you some perspective, fixed mortgage rates at that time were 5.4% and variable rates were 2.2%. So much lower than what we're seeing today. The 5-year fixed rates, they're very similar to what we're seeing today, but the variable rates were much lower, and that's a result of a lower interest rate. However, like Dan said, if things continue to trend the way they're going, variable rates should come down at some point here in the future as well. So while mortgage rates, and bond rates don't always work in lockstep with each other and with central banks because there's a lot of influencing factors. With that being said, I think if inflation continues to drop, there's no need to have interest rates as high as they are, and variable rates and fixed rates will come down with them.
So let's look to the States then, because of course they're doing something similar, and their Fed and what they're doing with rates understandably affects mortgages in that country as well. So the Fed came out on Wednesday and largely as predicted, they increased a quarter point. Now, some people thought or were pricing in that they wouldn't move, but hey, ultimately they did. This was the 9th hike in a row that they have made since they began. Now, the tone did change though, because they stated that further hikes are now not assured, which is softer. It's a little bit more dovish than the previous announcement when they basically stated that there was going to be ongoing increases. And a big understandable change in that sentiment came from the SVB bank failure that Ryan just mentioned, and of course, other credit pressures that are happening understandably across that region. As of now, it's actually shifted so that there's estimates of probably one more hike down south in 2023, and then probably a cut in 2024, and then 2 in 2025. But who can predict 2025 at this point? It's just things are changing so rapidly. And I guess the big thing that we want to touch on here is how are these 9 rate hikes affecting America? And understandably, it's a lot like what we're seeing in Canada, because as we know, in the States, you can get a 25-year, 30-year fixed term mortgage, which you can't here. Obviously we have 1, 2, 3, 4, 5, up to 10. Actually, RBC does have 25 years for those who didn't know. But what's very interesting is they're seeing a very similar housing outcome where prices dove, but then inventory is absolutely at near or at all-time lows in a lot of areas. People who got in with these incredible rates during 2020 up to 2022, they have no interest in selling or moving. And so there's just no homes being listed. So similar to what we're experiencing in Canada, incredibly low new listings hitting the market. Overall inventory is dropping across the entire region. And they are going to be experiencing, well, I think similar to here, what appears to be a bit of a flattening in prices, and a couple areas are starting to uptick as well. So we're really acting in lockstep right now with the States as far as our housing goes. But again, interesting to see Canada and the States separate with their rate hikes, having Canada obviously hold at their last announcement.
Yeah, and you got to think, Dan, too, if you could get a 25-year term on, say, a 3% mortgage, I don't know if they're that low at that duration, but my goodness, you'd rarely ever see that house come to market again. I mean, so it's no wonder that they're experiencing a shortage of supply as well. When you've had 2 years of extremely low rates, this is really affecting people who are on variable mortgages or who are buying now, right? But I unfortunately, if I'm looking, 5 years into the future here, I don't think it gets any better for buyers, unfortunately. And the reason for that, especially up here in Canada, 2022 was an exceptional year when it came to Canadian population growth. We broke 1 million people in terms of population growth. This is a massive number, massive. The total population grew by 2.7% last year. This is the most on record since the data started getting reported. In fact, it marks the first 12-month period in Canadian history where population grew at that rate. But the last time we saw a rate greater than this was 1957, which the population was obviously way smaller in terms of its actual size and grew by 3.3%. This previous population growth was related to the post-war baby boom that took place, as well as the Hungarian Revolution, where you took a lot of refugees in at that time. But this time round, it's completely different. 96% of that 1 million came from international migration. And Canada is by far the leading G7 country when it comes to population growth. And it has been for many years and probably will be for the foreseeable future. I don't think that this is a huge surprise to people, considering we've seen some pretty big and aggressive immigration numbers over the last 2-3 years as well. And I think if it's, if you're trying to figure out how the government's going to continue to float rising home prices and more taxable revenue, it's going to come from more and more people. And this is exactly what's taking place. And why I think if you break it down into our local markets here, I think people were expecting some, panic selling. We've gone over why that's not the case. Check it out in previous episodes. But now you're going to have more and more buyers coming to the major centers where jobs are, right? And we'll see the vast majority of this million end up in places like Montreal, Toronto, probably Calgary, Edmonton, and Vancouver. And so we're going to see a large portion of people here. I mean, the GVA grew by 80,000 people last year alone. So, we've got a housing crisis here. We now have, more and more buyers that are going to be mounting on each other. Some of these people won't be able to buy for a couple of years because of our foreign buyer ban, but our rental market will continue to see sustained pressure, at which point they will then turn into buyers at some point. So, now is a great time. If you're thinking of getting a property, look at what's coming in the future. It's pretty tremendous.
Yeah, quick note on where the people went in that last year. Amazingly, so BC saw its population grow by about 150,000. Alberta was over 160,000.
Wow.
Alberta got more people than BC in population growth in 2022.
We'll see if those people have been through a minus 40 degree winter before. See if they stay. But anyhow, it's likely because of the amount of work that's available in Alberta
and the cost of living in BC.
Totally.
We saw people from BC move east, one province, to Alberta because, yes, like you said, there's jobs, but two, it's just gotten too expensive to just live here for many.
You're spot on. Absolutely.
So wanted to share a little bit more about numbers here because, yes, it's clear that the government has the ability to open up the taps when it comes to population growth, but it's a little harder to build houses that quickly. And as a reference, let's go back to the 1980s. From 1980 till about 2016, average change in population for Canada was in and around 350,000 a year. And then it just kind of took off pre-COVID, obviously dipped then. And then, like Ryan said, we just cracked 1 million for the first time ever. And I believe the targets are equally as ambitious for 2023. So we may see back-to-back 7-figure population growth in this country. At the same time, dating back to the 80s, when we look at how many housing completions happened, it's almost a straight line, which is quite fascinating. And it sits around 200,000 housing completions per year, dating back to 1980, all the way up to today. So we're seeing a major spike in population growth for the last 5-6 years, but housing completions have not ticked up. They've barely moved. Okay, simple supply and demand economics. Yeah. Can anybody see a problem with that?
Yeah, inflated price, man. Here it comes.
350,000 people to 200,000 homes has been the norm for 40 years. And suddenly population went up by 3 times that, and the housing completions have not. So obviously that frames up my next comment here, which is about where we're at with rental units. So Canada's rental housing shortage, there was just an article released by the Royal Bank, by RBC, and this is backed by CMHC's data. So Canada's rental housing shortage will quadruple to 120,000 units by 2026 without a significant boost in stock. Right? We already know rental rates are basically, they're just off of their all-time highs. Where are they going to go next? This article is all about that. So In order to reach the optimal vacancy rate, which is considered 3%, Canada would need to add an additional 332,000 rental units over the next 3 years alone. And you compare that to them adding about 70,000 a year is the current rate, or at least it is over the last 3 years. So that 3% is optimal. That's still quite tight, but you got to think today it's at 1.9%. And I'm talking nationally here, which is the lowest vacancy rate we've seen in 21 years.
Wow.
Just back in 2020 and 2021, that was 3.4%. And now we're at 1.9. We look back to 2022 and we saw Canada's rental stock grew by only 2.4%. That's actually a decent amount. They hadn't seen that many additions to purpose-built rentals in almost a decade. So you would think, if they're hitting these bigger numbers, not seen in 10 years, that the rental market would kind of ease. Well, it didn't, right? Obviously, last year was all-time rental rates for basically the entire country. Now, immigration targets are set to grow something like 8% by 2025, which is 2 years from now.
Goodness.
Which ultimately means, of course, demand is unlikely to let up. When that 96 odd percent that Ryan mentioned of people coming to the country to affect that population growth are landed immigrants or temporary workers or students, these people are renting for the most part. So they're not buying first, they're renting first. And so you can imagine the pressure on that segment of the marketplace. You've already seen rental rates rise dramatically. And I guess this also makes me think too, a little bit of the investor segment of the market. Yes, investors right now are fairly squeezed in the sense that if you're buying your average condo in Vancouver with 20% down and you're getting your average rate, you're backwards on your monthly, like $800 to $1,000 a month, right? Your negative cash flow. So why are investors still coming into the market? Well, they've got access to this type of data. They're saying, okay, well, there's no question that if there's 3 times the people coming into the country, then there are going to be homes for them. Chances are rents are going to go up. Chances are appreciation rates are going to continue its upward trend as well. So I think investors, especially again, if you're picturing anything long-term being 7 years plus, this data alone is pointing towards prices and rents going up so that you're feeling somewhat safe. Again, especially when that asset class has outperformed many over the last 50 years, and with a lot of the banks even and the stock market always fluctuating, always a bit vulnerable. So, hey, why not put your money into a hard asset that you can have full control over?
Yeah, I think a couple things I want to add to this because I think it's really important. If you're an investor, number one, and you're looking at a condo in Vancouver and you're realizing that you're, like you've just said, Dan, you're probably backwards $800 to $1,000 a month. But if that particular property is going up by $2,000 a month in value, then you're winning, even though you're cash flow negative, right? And that's arguably what some investors do. That's they can cash flow or amend the cash flow side of it. And they know that the property, yeah, it's costing them $1,000 a month in cash flow, but in equity, it's going up by $2,000, $3,000 a month. That's a tremendous swing, right? And then furthermore, I think, when you look as an investor at Vancouver, man, the failure of Silicon Valley Bank, the fact that we saw massive runs on the bank, and we know that banks are investing, they can literally take out 10 times the level of your deposit down in the States, right? So if you put $10,000 into the bank, they can borrow $100,000 on your 10 grand. And then they take that $100,000 and they buy treasury bonds with it. Well, bonds went down like crazy, then people run on the bank. They had to sell for a loss, and here we are. And so I think as we continue to move forward, more and more people are going to want to have control over their money. And like you said, putting it into a hard asset, to me, makes a whole lot more sense going forward based on, the level of failure that we're seeing and how banks or central banks in particular are raising rates at unprecedented levels. You could have your money in something that cannot just disappear and arguably get consistent cash flow during a difficult time. To me, that's what investors are really looking at now too. So I just wanted to touch on that. And then also our government's kind of solution to this is pathetic, in my opinion. So according to CMHC, like you just talked about, Dan, Canada needs to build 3.5 million additional homes over and above the current projections by 2030 in order for housing to be quote unquote affordable again. That's 500,000 new homes a year. And it sounds like the official Housing Accelerator Fund has been launched, although it won't be implemented until June of this year. That's 2 years after it was announced by the Liberals who ran on that as a campaign promise. So they're 2 years behind the number that CMHC is also calling for, which is bananas. And again, when I went on and tried to find out what this Housing Accelerator Fund is actually supposed to do, it's very scant. There's not a lot of information on it. It's supposed to help governments reduce red tape, which leads to more homes being built. Again, I don't know why money is the solution to this. Maybe they need more employees to help manage and push these things through. But the expectation from this is likely going to be somewhere to the tune of 100,000 more homes. So again, it's going to fall way short of anything that the country needs. And again, it doesn't feel like to me that the government is really taking much action here. I would argue that David Eby, our premier, has done more in the time he's been elected than Trudeau has done in the 2 years since he made these promises.
So again, we've got a government that if they decide that they want to hit record immigration numbers, they can do that. And yet when they try to do something to improve housing affordability, they're 2 years behind. And again, it's a drop in a bucket trying to help create an additional 100,000 when 3.5 million are needed. Again, just a massive divide between population and housing. And it still feels like the two sides aren't even talking to each other. So it's setting up for a further housing crisis. And we're seeing that. And yet, interestingly, we saw when we're kind of turning it back to closer to home here, first off, real estate sentiment, which as I've been kind of reporting for a while here, has been in the dumps, like as low as the pandemic shutdown levels. Well, that's turning around, where in just the last 4 weeks, we saw the overall real estate sentiment improve to, or see the sharpest uptick that we've seen since the lockdown. So we feel it here. We know sales volumes are ticking up, and we know people are just feeling more optimistic here in Canada about real estate. We've got more calls, we've got more clients, we're seeing more mortgage originations, this type of thing in our sort of network. So it's tangible, you can feel it. And if you kind of pulled back a little bit further, the sentiment today is equal to where it was in early 2016. Who remembers that era? That was when housing prices were absolutely ripping. So again, completely different environment than 2016. I get it. But to think that sentiment is spiking right now means that people are feeling more confident in the marketplace. I think this is largely based on the Bank of Canada holding rates last time, and people starting to feel a little bit more, well, hey, maybe it's the sunshine that kind of affects people's mood here too. The sun came out 4 weeks ago. But jokes aside, it's an important metric because it starts with sentiment. If you feel better about the real estate market, it's going to push more people towards making a purchase or a sale. Now, when we look at what's happening here in Vancouver, just a quick thing too, because we've been talking about inventory a lot, and I want to discuss the detached market and what's happening here. We are basically sitting at a record low amount of detached active listings here today. There's just over 3,000. Okay, this is a record low for any March in recorded history. And there's only been 3 months in that same recorded history where inventory for detached homes was lower. December of 2015, when people take the homes off the market anyway, December of 2021, and January of 2022, basically the peak of all peaks. So there is no homes available when it comes to detached. That market is very sought after. And obviously and understandably, that's pushing prices up when there's so little inventory, yet so much interest. Looking at March alone, the median price of a detached home in GVRD is up $128,000. And I wanted to share kind of an anecdotal story here because it really kind of shows what the marketplace is like out there right now. Realtors are known for cold calling people, right? Trying to get them to buy or sell. we've had a couple of detached properties sell in East Van here recently. And the amount of cold calls I've gotten from essentially builders looking and asking, like, hey, do you have anything similar? Do you have any detached homes coming up, essentially tear downs because they want to build up a duplex, fourplex, whatever, it is phenomenal. I've probably had 8 this month. Buyers are cold calling realtors now. Like, it's completely turned around. It's fascinating. And of course, a big driver of this is the proposed Plex plan. Because if you buy a detached home now and you hold it, until 2024, and that Plex plan gets pushed through, the value of that lot increases tremendously. You can build, 4 to 6 doors on it, etc. So the detached home, as we've mentioned many times, is essentially going the way of the dinosaur. They are disappearing quick. They're not being built. And so people who hold on to a detached home for future value, I mean, it's a retirement plan in itself right there.
And Dan, much like you talked about, median prices are up $128,000 this month alone. And we just talked about how investors, right, are looking at, I might be negative $1,000 a month, even $2,000 a month. And you're looking at a median price change of $128,000. Right? So
in 1 month.
As an investor, when you look at that, is it any reason why they're cold calling you? It makes a lot of sense to me, right? And again, this is too many people and not enough homes. And that Plex plan, by the way, Dan, I think they have no choice but to implement it. I don't see how the city can make living more affordable without densifying and dividing the current land that's available. I just don't see how it's possible without that taking place.
Yeah, you have to let the open market be able to provide housing, because clearly the government hasn't to date been able to supply to the amount that they are seeing the country grow by.
It's not like they're going to lower our taxes. We know that. They are increasing our taxes. So, we know for a fact that it's not going to come from that side. It's going to come from the division of land and the increase of density. And so, like Dan said, if you have a single family home or you're thinking of buying one, get in touch with us. You need to figure out what's going to happen here in the near future, because you could see a whole lot more utility out of your home than was ever available before.
Perfect place to wrap it up. Thanks as always for tuning in, and we look forward to seeing you on the next episode. Have an awesome day.